Warren Buffett has long been recognized for his insightful investment strategies, and his views on real estate have evolved notably over time. Back in 2012, Buffett expressed strong enthusiasm for single-family homes, even stating that he would buy hundreds if it were practical, given the low prices and favorable financing available at the time. This optimism reflected a belief in the sector's potential for steady appreciation and reliable returns. However, recent developments reveal a significant shift in his approach. Buffett has moved away from residential real estate, signaling a change that stands out given his decades of market success. When an investor of his stature alters course so dramatically, it prompts close attention to the underlying reasons and broader market implications. Warren Buffett's shift away from real estate is rooted in a careful analysis of its underlying economics. While real estate has historically offered steady appreciation, hidden costs such as taxes, maintenance, vacancies, and insurance can significantly erode returns. The traditional advantage of leverage, using borrowed money to amplify gains, has also diminished as interest rates have climbed, making mortgages more expensive and shrinking profit margins. Additionally, real estate requires active management, from handling tenants to navigating regulatory hurdles, which demands time and attention that could be invested elsewhere. Compared to more liquid and scalable assets like stocks, these operational burdens make real estate less appealing to Buffett. Ultimately, he prefers investments that offer greater efficiency, flexibility, and potential for asymmetric returns, especially in volatile markets. When comparing real estate to stock market opportunities, Warren Buffett consistently favors investments that offer liquidity and operational efficiency. Real estate, while traditionally seen as a stable asset, often ties up capital and requires active management, making it less attractive during periods of uncertainty. In contrast, stocks provide the flexibility to quickly enter or exit positions, especially when market volatility creates temporary price distortions. Buffett recognizes that crises in the stock market can present rare chances to acquire high-quality businesses at deeply discounted valuations. These moments of asymmetry, where panic drives prices below intrinsic value, are far less common in real estate, which tends to move slowly and is influenced by emotional negotiations. Ultimately, Buffett's approach prioritizes assets that allow him to act decisively when opportunities arise, leveraging liquidity to maximize long-term returns. Warren Buffett's disciplined approach to maintaining substantial cash reserves is a cornerstone of his investment philosophy. By prioritizing liquidity, he positions himself to act decisively when markets present rare, high-value opportunities, often during periods of widespread panic or uncertainty. This strategy allows investors to purchase quality assets at deeply discounted prices, a feat that is seldom possible in the slower-moving real estate market. Unlike property investments, which can tie up capital and require ongoing management, cash reserves offer flexibility and readiness. Buffett's track record demonstrates that the ability to deploy funds quickly can lead to outsized returns, especially when others are forced to sell. Ultimately, his preference for liquidity over illiquid assets like real estate underscores the importance of being prepared to capitalize on market inefficiencies when they arise. Consider two distinct investment approaches. The first investor chooses to wait for a market downturn before committing funds, hoping to buy at a lower price. In contrast, the second investor puts money into the market right away and remains invested through periods of volatility. This comparison reveals that timing the market can be challenging, as downturns are unpredictable, and waiting may result in missed growth opportunities. Meanwhile, investing immediately allows for participation in long-term market gains, but also exposes the investor to short-term fluctuations. When evaluating final returns, especially after adjusting for inflation, the impact of these strategies becomes even more pronounced. The analysis underscores the importance of understanding market cycles and the potential trade-offs between attempting to time investments and staying invested for the long haul. Warren Buffett's strategy for investing during periods of market instability centers on identifying companies with robust financial health and enduring business models. He looks for businesses that demonstrate reliable profitability, possess the ability to maintain or increase prices, and operate in industries that are straightforward to comprehend. Examples of such companies include Coca-Cola and American Express, both of which have a long track record of consistent performance. By focusing on these resilient firms, Buffett aims to minimize risk while capitalizing on opportunities that arise during market downturns. His disciplined approach underscores the importance of fundamental strength and clarity in business operations when deploying liquidity in uncertain times. Warren Buffett's investment philosophy is rooted in simplicity and clarity. He deliberately steers clear of complex or speculative assets, focusing instead on investments that are straightforward and easy to comprehend. This approach allows for scalable strategies that can be efficiently managed, regardless of portfolio size. For investors who may not have extensive time or resources to dedicate to financial analysis, Buffett's method offers a practical and accessible path. By emphasizing transparency and ease of understanding, his philosophy helps minimize risk and fosters long-term financial stability. Warren Buffett understands that time is one of the most limited resources an investor has. When evaluating asset classes, he carefully considers the level of management each requires. Real estate, though known for its stability, often demands continuous oversight, maintenance, and decision-making. These responsibilities can quickly add up, making real estate ownership more labor-intensive than other investments. For many investors, the ongoing attention needed can become overwhelming and detract from other pursuits. Buffett's perspective highlights the importance of factoring in the time commitment when choosing where to allocate capital. Selecting the optimal entry point requires careful evaluation of assets, where the potential for quality far exceeds the associated risks. Waiting too long to act on such opportunities can mean missing out on significant gains. The most attractive investments are often found in resilient businesses that demonstrate consistent earnings and are led by capable management teams. Additionally, ensuring a margin of safety helps protect against unforeseen downturns. By focusing on these criteria, investors can enhance their chances of long-term success while minimizing exposure to unnecessary risk. A disciplined investment strategy prioritizes the protection of capital while seeking opportunities for growth. Rather than attempting to predict market movements with precision, this approach emphasizes the importance of identifying when asset prices become irrational. By maintaining adequate cash reserves, investors are positioned to act decisively when market sentiment turns volatile. Following a well-defined strategic plan ensures that decisions are guided by logic rather than emotion. This preparation enables investors to take advantage of market panic, acquiring valuable assets at favorable prices. Ultimately, such discipline fosters resilience and long-term success in the face of uncertainty. Warren Buffett's decision to steer clear of housing investments at present underscores a key principle: the value of waiting for truly compelling opportunities. Rather than acting on every market movement, Buffett demonstrates the discipline to hold back until the odds are strongly in his favor. This approach is often more challenging than it appears, as many investors find it difficult to resist the urge to act frequently. True success in investing often comes from patience and the ability to remain consistent, even when it means doing nothing for extended periods. By exercising restraint, investors can avoid unnecessary risks and position themselves for better outcomes when the right moment arises. Successful investing relies on a foundation of discipline and well-defined strategy, rather than mere speculation. By consistently following these principles, investors are better equipped to navigate market fluctuations and avoid impulsive decisions. This disciplined approach fosters stability and encourages thoughtful, long-term planning. Over time, such commitment leads to meaningful change and sustainable growth. The difference between short-term gains and enduring success often lies in the ability to remain focused and strategic, even when faced with uncertainty.